Time to sell. Time to sell your company. Oh no, that time has come. And in fact, maybe you're thrilled. Maybe it's like, wow, I can't wait to get out and start relaxing on the golf course or whatever it is that floats your boat. Maybe it's kind of like, man, I don't really want to sell, but I know I need to. I really don't want to. I really don't have the energy to do this anymore. For whatever reasons, it's time to sell. So that's what we're going to be talking about today on Small Business Daily. I'm Randy Kirk, and so if the whole business of selling your company is something that you think is a valuable thing to learn about, would you press the like button? And maybe you also want to subscribe at the same time, and maybe you'd like to be notified of future episodes that might also be of interest to you. So let's talk now about 3 methods of selling your business. One would be you give it or transfer it or transition to your children or other family members. Number 2, you transition or sell or give it to your employees. Number 3, you transition out and your partner, if you have a partner, the partner buys you out. Okay, those were 3 methods we discussed. You can go back and look at yesterday's episode if you'd like to learn more about those things. All right, now we're going to be talking about the hands-off approach. You don't have any personal relationship going into this one. The personal relationships with your children or your employees or your partner complicate the business of transitioning. It would seem in some ways like it would be a way simpler, but it's no longer arm's length. There's a lot of expectations and feelings and emotions and things that go on with regard to those kind of transitions. And those emotions and things are not quite as prevalent when you're selling it to a stranger. All right, so let's say that you've decided, no, not going to sell it to family members or any of those people, don't have a partner, so I'm going to sell it on the open market. Well, okay, there's a bunch of ways to do that. And I'm going to talk about basically 2 of them today. The most likely person to buy out your business is your competition. But the last person in the world that you want to know that you're thinking about selling your business is your competition. That gets a little complicated. Another likely person to buy you out and pay a high price would be a similar kind of business that's not competition. So if you're in one kind of retail and somebody else is in a related retail business, they might want to expand into what you're doing, but you're not truly competitors. That's a much easier kind of situation where you can pick up the phone or drive down to their location, walk in the door and say, hey, let's talk. let's have a conversation here. So those kinds of transactions are the highest, most likely way to get you the highest dollar for your company. If you know somebody like that, if you think that there's somebody you can talk to privately that's not going to take advantage of that conversation, highly recommend that that's where you start. Sometimes today in retail and wholesale, we're seeing manufacturers buy out the retailer or manufacturers buying out the wholesale businesses that they sell to. This is another possibility. In our complicated world with Amazon and everything else going on, there's a lot more manufacturers owning their retail locations or manufacturers buying out wholesalers as they become available to purchase. Sometimes manufacturers are walking in and buying out wholesalers even before they thought they were going to be available for sale. So those are some possibilities within your industry, within your neighborhood, your community, where you might be able to put the sale together without paying a brokerage fee. And also you're going to get the highest dollar because those individuals are going to know much more about what the value of your company is than a complete stranger. Okay, so those are possibilities. Check those chances out. Now we'll go to the other, and these are businesses are sold like this every single day, and that is to use a business broker. Now, I'm going to tell you right now that I don't know something, okay? There have been in the past, but I don't know if there are today, business brokers who make all their money trying to prepare your company for sale. They charge thousands of dollars, tens of thousands of dollars to prepare brochures, to do asset analysis, to bring in accountants to come in and make sure that the books are audited and all this kind of stuff. They typically will still make their 10%, but they really, if the truth be known, they make their money preparing your company for sale. They make loads of money doing that. I would beware of those kinds of folks. I don't think they can do any better job of selling your company than the folks who don't charge for that. And there's plenty of brokers out there who don't charge anything for any of that. In fact, do a lot of it within their 10% commission, not the audits, of course, but will do the preparation of a brochure, the preparation of really getting a handle on where you fit in the marketplace, et cetera, without charging you a dime. So I'm going to highly recommend you look for a broker that flat 10%, that's what they charge. The other thing is, when you're looking for a broker, like any other broker, they're all going to want an exclusive. And they're going to do some hard work. So in a way, they deserve an exclusive. And maybe you'll want to give them an exclusive. But if you're going to give them an exclusive, I would certainly interview 2, 3, 4 brokers before I made that decision. You want to get somebody that you think knows and understands your business and who is got some track record, some realistic evidence that they're selling businesses on a regular basis that are similar to your business, that they understand your kind of business. I mean, there are brokers out there that specialize in retail. There are businesses that specialize in restaurants. There are businesses that specialize in manufacturing. So you want to look for a broker who's going to get you, who understands you. And if you don't think they do, you might even ask for a recommendation of somebody that's more specific to your industry or where you fit in the supply chain. So you've picked a broker. You've got the broker all ready to go. Now he's going to tell you some of what I'm going to tell you anyway, but it's good to know ahead of time what to expect. You are going to want to get the most money you possibly can for your business. And the question is, how do you value your business? I'm going to point you to When Friday Isn't Payday. In there, you can pick up a copy of When Friday Isn't Payday. And these things I'm going to be talking about are described in great detail with the math all laid out and everything so that you can kind of work it through. I'm going to kind of take it at the 25,000 foot level and just give you kind of the idea of various ways to value companies. The most likely way to value a bigger company, let's call it a $1 million or $2 million plus business, is going to be to take a multiple of expected future earnings. So you're going to create a perspective. You're going to do a forward-looking balance sheet and a forward-looking P&L, and you're going to show based on history that it's likely that the company is going to make $100,000 next year, $200,000 the year after that, $300,000 the year after that, whatever it is. You're going to show this process of the company growing and becoming more and more valuable over time. And then you're going to apply a formula to that, which is going to give you a current value, maybe based on 5% interest or 7% interest or 10% interest, but it's all a mathematical formula. This is, again, useful for larger companies, but also companies that are definitely on a growth path and where that growth path is provable. It's obvious. Then nobody's going to argue with you that the company is going to be growing over the next several years. So that's one method. Another method that is used for retailers and wholesalers and manufacturers is to use a multiple of current income. So here again, you're going to need to show profit and loss, and you're going to need to show balance sheets, probably your bank statements, other things to prove this. What has your income been over the last 3 years? What has been the company's income over the last 3 or even more years? And some evidence that this will continue. The income number needs to be refigured, okay? When you're doing a sale, it's not just what you're currently showing as the profit of your company after all expenses, including your income, but you're going to take that number and you're going to add back in your income. If your spouse is working for the company, possibly you're going to add back that income. You're going to add back any kind of fun benefits that you're getting that you can prove are kind of not necessary for the business to go forward. So you're going to add those benefits back in. You're going to add any, even sometimes, not just you and your spouse, you might have kids working for you that are not exactly pulling their weight. If you can prove that position's not going to be necessary, sometimes you can add that amount back in. So you're going to add these amounts back in order to come up with the gross amount of real net income that the person can expect to achieve once they're running the business. They can choose to split it up any way they want to. They can hire their kids and their spouse, and they can, have all the same benefits, or they could just take the entire amount as personal income, or they could take part of it as personal income and part of it as corporate income, maybe because of tax issues or whatever else. But you're showing the total amount of income that they can expect to achieve going forward based on historical evidence. Now then, what is the multiple? Well, it depends completely on the industry. For manufacturers, it may run as much as 5 or 6%. Ask your broker what the current multiples are. For restaurants and some retail, it's going to maybe be 3 or 4%. For service businesses where the owner is a personality that's going to be an important loss to the company, it might be as low as 1%. So, 1 times. Let's do that again. Where it is a service business where the owner's personality or personal skills are going to be missed. In other words, people who come to the company after that owner has left are like, well, I only want to deal with George, and George is no longer here. Where there's a personal relationship going on in a service business, the multiple might be as low as 1. It might be 1 year's profits. Okay. Now there's other ways to do that same thing, although they're not used as much for small companies. You can use a multiple of sales. I don't recommend using a multiple of sales. I think it's much more iffy because what are the margins and how are we going to figure out what the overhead needs to be compared to the gross profit after cost of goods sold or cost of services. So I don't think the multiple of sales is nearly as good a way to look at valuing a company. Okay, then you could also have maybe a company is not making that much money and possibly it's going to be an asset. Well, we'll talk about that in a second, but possibly it's going to be an asset sale where it's based more on liquidation than it is on the value of the assets. So in a normal sale, you're going to sell all your assets with the company. Nobody wants your liabilities, so you're going to keep the liabilities. That's just all part of the dollar transaction. So you're going to have to get enough money in the transaction to pay off those liabilities. But at the same time, part of the transaction is the assets are going to be included in the final dollar amount that you've discussed. So that's just the legal way that you're going to do this. And then there's going to be other things like the value of the reputation, the value of any trademarks and intellectual property, things of that nature that may have tax advantages by depreciating some of these things. So, but getting out of the weeds for just a couple of seconds, you are going to have, in some situations, there's not much value left in the going concern. And so what you're really trying to get out of the company, what the buyer really wants to get out of the company is at least the liquidation value of all the assets, the accounts receivable, the products, the fixtures, the warehouse equipment, the manufacturing equipment, anything that could be looked at as an asset, intellectual property. So you're going to come up with some kind of a value that is closer to the liquidation value because the individual is not willing to pay anything for the income stream that they're buying. They're basically going to take those assets and potentially apply them to an existing business. So those are some of the different ways to value a company. Again, when Friday isn't payday, goes into it in depth and gives you some mathematical examples so that you can kind of see how it works. But your broker may have other methods. I haven't heard of other methods, or I would tell you about them now, but those are the traditional methods for arriving at a value. Having said that, what do you need to do to maximize this value? Well, one thing you need to do is you need to start thinking about the way you do your books 2 years ahead of when you're going to sell. Because right now, you're probably doing your books in some way to minimize your taxes. Well, if you're minimizing your taxes, you're minimizing the income. You're minimizing the income to you. You're minimizing the income to the company. So you're not doing anything to maximize the value of the asset that you have there. So 2 years before selling, you switch your accounting method. It's not a different method, it's a different strategy. We'll call it that. You switch your accounting strategy. You go to your CPA and you say, look, for the next 2 years, we're going to want to make as much money as we possibly can. We're going to want to show that I make a lot of money, that I have a lot of profit at the end of the year, even after I take my income out. We're going to maximize the profit picture for this company. Now, again, you don't have to completely change every tax advantage that you're getting, because if there are obvious tax advantages that are not necessary to the continuation of the business as it has been set up, then those will be added back in anyway. But sometimes we're doing things that are a lot more special. I'm not going to go into details on this video, but I think you know what I'm talking about. You may be doing things to drastically limit your income line or your margins so that it doesn't cost you as much at tax time. So those things need to go away for 2 years so that you can maximize the value when it's time to sell. So for the last 3 days, we've been talking about selling your business or buying a different kind of business. And I'm sure you might want to go back and look at those last 2 days, or you may want to buy a copy of When Friday Isn't Payday. I go into a great more depth with some numbers and some statistics and things that might help you with regard to either buying a new company or with regard to selling the company that you have now. So this is Randy Kirk with Small Business Daily. Look forward to seeing you tomorrow.